Welcome traders, welcome. In this video, I'm going to be going over the Fibonacci retracement tool. So the Fibonacci retracement tool is a way to find different retracements in the market and what is actually for the next pullback that is needed for each time in the market. So with that being said, the Fibonacci retracement tool is just showing you different levels. So the way that I use my Fibonacci retracement tool, I'm actually gonna use and give you guys the levels that I use. And pretty much you can go ahead and screenshot that. Let me drag this over. You can screenshot it, use those numbers. These are the common numbers of the Fibonacci retracement and what they mean. So you have the 0% line, which is your 100%. And when it comes to complete Fibonacci retracement tools of how that's going to be. And Fibonacci retracement tool is basically just to find patterns in the market where it is most consistent of actually going from the next impulse move. So the market has different impulse moves to go from up, down, finding a different pattern. Now, the reason I do not use the Fibonacci tool very often, this Fibonacci tool can be used in so many different manners on different time frames, making it a very inaccurate tool of how to read the market. It is usually used to find out where the median market is. So I will go over some of the numbers and what they mean. So anything that is between 23.6, which is right here, and 0% is a consolidating market. The market will just move sideways if it is trapped between the 23.6. Anything that taps the 38.2 is usually a strong trend, and it validates on the trend, meaning if the trend is going to be strong or if not. You have the 50%. The 50% means the market is basically neutral. The buyers and sellers are neutral. Then you have the 61.8%, where the market is starting to slow itself down, and actually the trend is starting to die. And when you get to the 78.6 and you get to the 88.6, the market actually has really started to slow down, and the trend is more than likely looking to turn around. At the 100% mark, the market can stay within the 100% range from its last impulse move, and it lets you know if it broke structure or not. If it goes past 100%, it has broken structure. Structure is no longer valid for that trend anymore. This is the textbook way of how people explain it to most individuals. The 110% is where your stop loss would be, and the 120 is also where your stop loss would be. I personally, like I said, I do not use that. And then you have the 127% and also the negative 27%. I will show you how I use them, and it can be used on different time frames, and I will show you how. So with that all being said of how the Fibonacci is, you go from the last extreme high to the last extreme low where the market actually physically stopped. And then you want to go ahead and match up where the wick is and where it stopped. So what I like to do is I like to get as close as I can for the Fibonacci retracement. Then I like to lock in the Fibonacci retracement so it doesn't move. If you don't lock it in, then what's going to happen, you're going to start playing with your screen and moving it around, and then you'll mess up your Fibonacci, and then it'll start moving around and it won't have an accurate reading. So your last extreme high to your last extreme low, you lock it in. So in this scenario, the market has shown you from this extreme high, which is at 100%, came all the way down to the 0% line. This is a projection for this next impulse move. This whole impulse move, this is a projection for it. It's based off of where the market stops. So in this case, the market stopped at the 38.2. At 38.2, you can expect a very hard push up, and it can stop there, and that's good, and it did. But in this scenario, it broke 100%, meaning this downtrend is no longer valid. So this is where your stop loss would have been if things got out of hand, and it gives you way too much room to mess up in the market. That is a lot of pips that you would have messed up in the market. And this is why I do not use this tool very often. Went past 127%, making everything invalid. That trend has been broken. Just for the following tool to go all the way back down past 100%, meaning it broke. This next one, on this next structure, it broke. So I'm gonna go ahead and delete that. So the next structure it broke, so then you get the Fibonacci tool again, last extreme high to last extreme low. And in this instance, it's trying to project what this next move is for this morning. You'll have it snap in, it locks. All right, so in this scenario, 38.2 again is where the market kind of stopped. It came all the way down, did not respect that level of 38.2, went all the way down to 23.6, bounced off of 38.2, then bounced off of 50%, then bounced off of 61.1% or 61.8. This is why I don't use it, because it bounced off all three levels and continued to keep going. That is a very bad indication that this tool will help you in any sort. So when you take it to smaller time frames, you'll have a different mix of what else is going on. So I'm going to delete this bigger one. And on smaller time frames, you can have your Fibonacci retracement tool come in. So your last extreme high to your last extreme low. And it's supposed to project what the future is supposed to do. So as you've seen before, structure has been broken. It came down to 38.2. Then it bounced off of that, then bounced off of 110%. So in this instance, you have mixed signals of how many times this thing's bounced off. And you're like, oh, okay, so well, textbook style says that this tool should go to, much higher. Okay, but where's it supposed to stop? This tool is just trying to think or make you think that, oh, I know where the market's going to go, and this is how the market can disobey Fibonacci at any time. It does not respect it. That's why I do not use this tool. Again, the market can disrespect the Fibonacci retracement tool as much as it wants. It does not have to follow it. Many traders do not explain that to people, and that is why I do these videos, to help traders who are in the beginning, and also I like to give back to a lot of people of why I didn't have so much success in the beginning. So with that being said, you can choose to use Fibonacci however you want to. I choose not to use it. Fibonacci can easily go into harmonics. I do not use those either, because the market can easily break any one of those and not respect anything. So in my next indicators video, I can see you guys in my next indicators video. I hope that you guys have a blessed day, and see you soon.